Welcome to TalkTickers.
Great to be here.
Today we're diving deep into Upstart's first quarter 2025 earnings call.
Yeah, quite a bit to unpack from this one.
Our mission, as always, is to pull out those key insights, understand their performance, and figure out what it might mean going forward.
Absolutely. Let's get into it.
So, kicking things off with the results snapshot. What's the big picture?
Well, the headline is definitely strong growth. I mean, really strong. Even with the usual Q1 slowdown, they reported significant year-over-year gains.
Like what specifically?
Okay, so platform originations were up 89% year-over-year. That's huge.
Wow, okay. 89%.
And revenue followed suit, up 67%. Adjusted EBITDA margin hit 20%, which is, quite healthy.
And profitability, weren't they close?
Very close. Yeah, they mentioned being near GAAP profitability in Q1. Plus, seeing real momentum in the newer stuff, like home and auto loans.
Right, I saw that home equity and auto originations, big sequential jumps, 52% and 42% respectively.
Exactly. It really looks like that diversification strategy is starting to pay off.
And they mentioned their macro index. What's the read there?
Their view is that consumer financial health, while maybe a bit elevated, seems stable for now. And crucially, credit performance looks healthy within their own book.
Good, good. Okay, let's zoom in a bit. Starting with their core, personal loans.
Right. So personal loans, originations were kind of flat compared to Q4.
Okay.
But, and this is key, still up 83% compared to last year.
So still massive year-over-year growth, just not sequential growth this time. What's driving that performance?
It looks like efficiency gains are a big part of it. Conversion rates jumped pretty significantly from 14% last year to 19% this Q1.
And that's down to?
Well, they point to model improvements, their AI getting smarter, and also just better capital supply, helping them approve more loans.
Makes sense. And the automation level?
Record high. 92% of personal loans were fully automated. 92%.
That's just incredible efficiency. Are they moving up market too? Is there something about super prime?
Yeah, definitely. Almost a third, 32% actually, of originations went to super prime borrowers. So scores over 720.
Okay.
And they're saying they're winning more deals against competitors right across the different credit tiers.
Which suggests their rates and process are really hitting the mark.
Exactly. Oh, and they introduced something new in their underwriting model, embeddings.
Embeddings, right. Break that down for us. Why is that significant?
Okay, so think of it like it's a way for the AI to find really subtle connections in the data. Patterns that aren't obvious, maybe combinations of factors that predict risk better than, just looking at a credit score.
So finding hidden signals.
Kind of, yeah.
Yeah.
It helps uncover these nuanced relationships for hopefully a more accurate risk picture. They highlighted it as a pretty novel application of this AI technique, specifically for credit underwriting.
Interesting stuff. Okay, let's switch gears. Auto lending. That 42% sequential growth really stands out.
It really does. Almost 5x year-over-year growth, too.
Wow, what's fueling that?
It seems to be a mix. Model updates, again, better pricing, making them more competitive, but also their cross-selling seems really effective.
Cross-selling.
Yeah, offering auto refinance to existing customers. It cut their acquisition cost for those loans by 57% just from Q4. And conversion rates more than doubled.
57% cost reduction is massive.
It is. And they even hit their first instant approval for an auto refi. Took just 9 minutes. Shows that automation push isn't just in personal loans.
9 minutes. Okay. And HLOCs, similar story.
Yep, strong growth there too. 52% up quarter over quarter, and more than 6 times the volume compared to last year.
6 times.
A big factor seems to be porting over some of their tech from personal loans, the instant income and identity verification stuff.
Leveraging existing tech. Smart.
Right. It boosted instant verification rates, boosting conversion. They also launched HLOCs in California, so now they cover states with about 75% of the U.S. population.
Expanding reach.
And importantly, they signed deals with 3 partners to fund these HLOCs, getting them off their own balance sheet.
Okay, that's key for scaling. What about the small dollar loans?
Still growing steadily. Up 7% sequentially, almost tripled year over year.
Is that a big part of the business?
Not in volume, maybe, but it's a really important customer acquisition channel. They said almost 16% of new borrowers come through that product.
A funnel.
Exactly.
Yeah.
And now it runs on the same core underwriting model as the main personal loan product, so it gets the benefits of things like those embeddings we talked about.
Okay. So origination is humming. What about managing the loans afterwards? Servicing.
They're automating there too. 90% of hardship applications are automated now.
90%.
And they're actively working with borrowers who are struggling. Direct collections efforts led to a 50% jump in debt settlement acceptances.
That sounds proactive.
And on the auto side, recovery rates on defaulted loans actually doubled year over year. They're also hinting at launching their first machine learning model in servicing soon.
Oh. What's the significance there?
Well, it could be a step towards offering servicing and collections as like a standalone product eventually.
Yeah.
Another potential revenue stream.
Interesting. Okay, let's tie this back to their 2025 priorities. How are they tracking?
Seems like they're hitting their marks. First, the AI leadership embeddings is a key example they pointed to.
Right.
Second, getting the funding ready for growth. Over half their loan funding is now locked in through committed partnerships. That includes a new deal with Fortress. Plus, they added 15 new partners just for the super prime loans.
So securing the capital pipeline.
Exactly. And third, profitability. They reiterated they're on track for GAAP net income in the second half of the year.
And the best rates, best process mantra.
Seems to be working based on those improved win rates they mentioned, especially in personal loans.
Okay, let's dive into the numbers a bit more. What did the CFO highlight?
All right, financials. Q1 total revenue was about $213 million. That actually beat their guidance.
Why the beat?
Mostly higher net interest income than they expected. Fee revenue was $185 million, up 34% year over year.
And the net interest income?
Came in around $28 million, which was $13 million higher than they'd guided. They said higher spreads and some fair value gains helped there.
Got it. Loan volume.
About 241,000 loans originated. That's up a huge 102% year over year, though slightly down like 2% from Q4.
Okay, typical seasonality maybe.
Probably. Average loan size ticked up a bit to around $8,865. Contribution margin held strong at 55%.
And expenses?
GAAP operating expenses were about $218 million, actually down slightly quarter over quarter.
Leading to?
A Q1 GAAP net loss of just $2 million, much better than expected. Adjusted EBITDA was $43 million, and adjusted EPS was $0.30.
Solid performance versus expectations. What about the balance sheet?
They ended Q1 holding about $726 million in loans, which is up sequentially, and they have $600 million in unrestricted cash. Seems like a decent cushion.
And they took steps to improve flexibility.
Yeah, they put in place a universal shelf registration and a $500 million at the market, or ATM, program. Gives them options. And we mentioned Fortress is now a new committed capital partner.
Right.
Okay, outlook time. What are they forecasting, and how do they see the economy impacting things?
They acknowledge there's more uncertainty now, particularly around inflation risk, even though they haven't seen a huge macro impact on their credit performance yet.
So caution.
Definitely some caution baked in. For Q2, they're guiding to total revenues around $225 million.
Okay.
That's split between roughly $210 million in fees and about $15 million in net interest income. Contribution margin expected to stay around 55%.
And bottom line for Q2?
They project a GAAP net loss around $10 million, but adjusted net income around $25 million and adjusted EBITDA near $37 million.
And for the full year?
Full year 2025, they're guiding to about $1.01 billion in total revenue. Adjusted EBITDA margin around 19%, and importantly, they expect positive GAAP net income for the full year.
Positive GAAP net income for the year. That's a key target.
Absolutely. And it's worth noting their guidance assumes no Fed rate cuts this year. So arguably conservative on that front.
Right, building in some buffer. Okay, the Q&A with the analysts often adds color. Any highlights there? Yeah, definitely a few interesting nuggets. The Walmart partnership OnePay, they clarified it just launched. It's a one-year deal for now, and don't expect it to move the financial needle much this year. It's more strategic positioning.
Got it. Anything on conversion rates?
They expect them to keep improving with the model enhancements, but acknowledge macro factors obviously play a role too.
Makes sense.
They also mentioned simplifying how they present their macro index data in the investor deck, because the old way caused some confusion.
Okay. And the contribution margin pressure.
Explain that's mainly the mix shift. More prime and super prime loans have lower margins because it's more competitive there. Plus, the newer products like HLOC and auto just aren't at mature margin levels yet as they scale.
What's driving loan demand?
Debt consolidation remains a really big driver for personal loans.
And funding. How are they thinking about that mix?
They want a balance. Lender partnerships, committed capital deals like Fortress for stability, and then using the securitization market more opportunistically. The committed deals give them resilience if markets get choppy.
Which explains the take rate pressure we discussed earlier, right? Success in lower rate super prime.
Exactly. It's a strategic choice to grow there, even if it lowers the average take rate. Diversifying into super prime is a priority.
How have funding partners reacted to recent volatility?
They said partners in committed deals reacted as expected, no pullbacks. The securitization market, though, has seen spreads widen a bit and advance rates dip slightly.
So ABS is more of a nice to have than essential right now.
Seems that way. It's opportunistic. They also confirmed their risk retention levels in deals haven't changed.
What about the market opportunity? How big is super prime versus their traditional segments?
In personal loans, they see the total addressable market, or TAM, as roughly split evenly between prime, super prime, and near subprime. So moving into super prime essentially double their personal loan TAM. And obviously, home and auto TAMs are vastly larger overall.
Okay. Any other quick hits from the Q&A?
Customer acquisition channels have been pretty stable. Take rates within specific risk tiers are also stable, though they're always experimenting with fees. Sales and marketing spend as a percent of originations was flat, even with push into prime, suggesting maybe that marketing is still ramping up.
And loan performance.
Newer vintages, like from late last year, are showing some normalization, which reflects that higher mix of prime loans, lower losses, but also lower initial yields.
How do investors view the returns?
They see the spread between Upstart's returns and treasuries, reflecting current risk and uncertainty. The focus is really on return on equity ROE.
And the Walmart deal economics.
Shared economics, basically. Walmart brings the customer, Upstart provides the product, both benefit. A win-win setup is how they framed it.
Okay, that was a thorough rundown. Now for our favorite segment. This is not financial advice. Let's toss around some outrageous but plausible trade ideas based on this call.
All right, let's do it. Idea number one, building on that automation theme, especially in auto. Given Upstart's tech, the instant approvals, the best process goal. Consider going long Upstart and maybe pair that with a short position on a sort of old school traditional auto lender, one that's still heavily reliant on branches, manual processes, that type.
The thesis being Upstart's efficiency just eats their lunch over time.
Basically, yeah. Tech disruption, stealing market share from the incumbents. Plausible, maybe outrageous, depending on the specific short target.
Okay, I like it. Here's another angle. Focus on the super prime push and debt consolidation.
Go on.
Long Upstart, again, naturally, but pair it this time with buying some, say, out-of-the-money put options on major credit card companies.
Betting against the card issuers.
Yeah, the idea is if Upstart successfully offers better rates to high-quality borrowers looking to consolidate high-interest credit card debt, they could start peeling away some very profitable customers from the big card companies. It's a bet on Upstart winning the rate war for prime borrowers' existing debt.
Ooh, that's interesting. Hitting the card companies where it hurts. Again, definitely falls into outrageous but plausible.
All right, that brings us to the end of this deep dive on Upstart's Q1 2025 call.
Yeah, lots happening there. The AI advancements, the funding strategy, the push into new loan types. Definitely a company in motion.
Absolutely. What stood out most to you listening in today? It's worth thinking about how these pieces fit together for Upstart's future. And keep an eye out for their AI Day next week, likely more details then.
For sure.
Thanks for tuning in to TalkTickers. Join us next time for another deep dive into the world of earnings.